The exact moment. The AI bubble burst. The AI bubble. $423 billion bet on the future or the next dot-com crash. An Indian company with 2 employees just saw its stock surge 55,000% because it added AI to its business description. Nvidia just reported quarterly revenues of $39.3 billion, up 78% year over year. Corporate spending on generative AI exploded from $11.5 billion in 2024 to $37 billion in 2025. That's a 3.2x increase in 12 months. Is this a revolution or a bubble? The answer is both. And understanding the difference between revolutionary technology and irrational valuations is the key to navigating what happens next. Today we're dissecting the AI bubble, how it grew so fast, why smart people are worried, and what the 3 most likely scenarios are for 2026. Let's get into it. First, let's be clear about what we mean by bubble. When people say the AI bubble, they're not saying AI is fake or useless. They're saying valuations and expectations are running far ahead of actual revenues, profits, productive capacity, and sustainable demand. A bubble can exist even when the underlying technology is genuinely revolutionary. The difference is between technological revolution, which AI absolutely is, and prices that anticipate 10 years of success in 18 months, which is what's happening now. Think about the dot-com bubble. The internet was real, it changed everything. But in 2000, the valuations were insane relative to the business models and cash flows that actually existed at the time. Hundreds of companies went to zero. The technology survived and thrived. The bubble companies did not. So the question isn't whether AI will transform the economy. It will. The question is whether current prices, spending levels, and capital allocation reflect realistic timelines and returns. And that's where things get interesting. Let's break down the forces that created this explosion. Driver 1, from software to compute infrastructure. Generative AI transformed AI from a software story into an industrial infrastructure race. This isn't just about algorithms anymore. It's about chips, cloud capacity, data centers, and energy. The numbers tell the story. Nvidia reported Q4 fiscal 2025 revenues of $39.3 billion, up 78% year over year. Databricks hit a revenue run rate of $4.8 billion in 2025, up 55% year over year, and was valued at $134 billion in its latest funding round. This is an industrial boom disguised as a tech story. Driver 2, the CapEx arms race. The heart of the bubble isn't just the applications, it's the colossal spending on infrastructure, driven by fear of being left behind. Every major tech company, every cloud provider, every enterprise is pouring money into AI capacity because they're terrified of losing competitive position. Menlo Ventures estimates that companies spent $37 billion on generative AI in 2025, up from $11.5 billion in 2024. That's 3.2x growth in 1 year. And according to UBS, via Barron's, global AI spending could jump from $423 billion in 2025 to $571 billion in 2026. This is not organic growth, this is a panic-driven arms race. Driver 3, enterprise demand is real but monetization is slow. Here's the paradox. McKinsey's 2025 global survey shows that AI adoption is broadening and companies are experimenting with agentic AI systems. Usage is growing. Pilots are everywhere, but converting pilots into scalable, profitable deployments is incredibly hard. Most companies are still figuring out how to actually generate ROI from their AI investments. So you have real demand, real usage, but uncertain monetization. That gap between activity and profitability is where bubbles live. Now let's talk about why serious people are worried this is a bubble. Warning sign. 1. Disproportionate spending and valuations. When spending triples in a year and valuations hit levels that require decades of perfect execution to justify, you're in bubble territory. The speed of capital deployment exceeds the speed at which real value can be created. Warning sign 2. AI washing everywhere. Remember that Indian company with 2 employees whose stock surged 55,000% after adding AI to its business description? That's not an investment, that's speculation based on narrative, not fundamentals. And when that starts happening at scale, it's a classic bubble signal. Warning sign. 3. The shift to debt financing. When hype is high, equity capital is cheap and abundant. When hype starts to cool, Companies shift to debt and bond markets to finance growth and capital expenditure. This makes the system more fragile because risk moves to places where it makes less noise until it breaks. Warning. Sign 4. Infrastructure bottlenecks. The race to build data centers is hitting constraints: energy availability, chip supply, construction capacity. When demand for infrastructure outpaces the ability to build it, costs explode and projects fail. That creates a shakeout. Here's the useful answer for understanding this economically. AI is real. The technology works. It will transform industries. But there can still be a bubble at 3 different layers simultaneously. First, a valuation bubble in stock prices and startup valuations that assume flawless execution and infinite growth. Second, a capex bubble in infrastructure spending where companies are overinvesting relative to realistic demand timelines and returns. Third, a narrative bubble in companies that are purely AI story, with zero underlying fundamentals. The key insight is this: bubbles don't pop all at once. They pop where the fundamentals are weakest. The infrastructure players with real revenue might be fine. The AI wash companies with no business model will get destroyed. Let me give you 3 realistic scenarios for what happens next. Scenario 1. Soft landing. Most probable. AI spending continues growing but at a less hysterical pace. The market separates winners, real infrastructure and platforms with actual customers, from imitators. UBS estimates global AI spending could reach $571 billion in 2026, up from $423 billion in 2025. If that happens, this isn't the end of the bubble. It's normalization with continued strong growth. Winners consolidate, losers fade, but the sector stays healthy. Scenario 2. Credit stress and shakeout. The underestimated risk. Too much capex, too much debt, compressed margins. Some AI companies can't service their cost of capital. The market hits cash-burning companies that depend on continuous refinancing. This is the version of a bubble pop that doesn't look like 2000. It's more like a brutal selection process via credit markets. Companies with real cash flow survive. Everyone else gets wiped out. This scenario is more likely if interest rates stay elevated or rise, making refinancing expensive. Scenario 3. Second euphoric wave. If rates fall and demand accelerates. If central banks cut rates aggressively and enterprise AI demand truly scales, you could see another wave of euphoria with even higher multiples, especially in chips and cloud infrastructure. But this is the most fragile scenario. It would likely create even bigger excesses, setting up a harder crash later. If you want to track where this is headed, here are the 6 indicators to monitor. First, global AI capex. Watch spending on cloud infrastructure, data centers, and chips. If it decelerates sharply, that's a warning sign. Second, profit margins. Who's actually making money and who's burning cash? Margin compression is an early signal of trouble. Third, credit spreads on AI-heavy companies. If bond spreads widen significantly, the credit market is pricing in higher default risk. That's when things break. Fourth, real interest rates. Higher real rates make it harder to justify enormous valuations on future cash flows. Fifth, enterprise adoption conversion. McKinsey points out that moving from pilot projects to production-scale deployment is a major bottleneck. If that bottleneck persists, revenue growth disappoints. Sixth, AI washing. How many companies are riding the narrative with zero substance? When those start collapsing, the bubble phase is ending. Here's the bottom line. The AI bubble isn't about AI being useless. It's about too much money chasing too much, too fast, in pursuit of a future that requires time to actually materialize. AI will transform the economy, but not every company calling itself an AI company will survive. Not every valuation is justified, and not every dollar of capex will generate a return. 2026 will be the year the market starts separating reality from hype, and that's when the real opportunities emerge. If you want more analysis on tech, markets, and the global economy, subscribe and let me know in the comments which scenario you think plays out. I'll see you in the next one.